Hi there, eToro. It is Monday, the 11th of October, and that means that it is time to take a look at what happened in the markets last week. Before we begin, I wanted to talk about a podcast that I recorded with Copy Traders Club last week. We discuss my background in a fair amount of detail, my attractiveness or lack thereof, as well as a number of other topics relevant and some irrelevant to eToro. If you want to listen to that, you can visit Copy Traders Club on YouTube. And if you don't want to learn more about me, that's also cool. There are lots of other PIs that have recorded podcasts with the Copy Traders Club. I find them quite entertaining, so I recommend you have a look. So over the last week or so in the S&P 500, we saw a bit of a bounce, still some ground to make up, given the pullback that we've seen in the past month or so. Over the past 12 months, the S&P 500 has roughly given a return of about 27%, whereas my portfolio has given a return of 33%. So the price of oil and energy has been rising around the world. I wanted to start with this because it's a global phenomenon and not tied to any specific geography, which means that energy stocks have had a pretty good run over the past month or so. I was holding some energy companies, traditional energy companies for a while, but I've exited those positions just because the price of any commodity is very difficult to predict. And oil has been pretty volatile in recent weeks, months, and years. Okay, now looking into the geographic view, UK stocks have been a right pain in the arse over the past week. You can see that the top or the bottom four performers are all UK stocks, and this is for a few reasons. But one of those reasons is that UK stocks are out of fashion at the moment. There are a number of things to consider when you're investing in anything, but the fashion trend, what's fashionable at the moment, is definitely one of the things to be aware of, even if you aren't participating in it. So ARK Invest, for example, was very fashionable towards the beginning of this year, and by the middle of this year was no longer fashionable at all, despite not too much changing actually within the space of 3 months or 6 months. So I think that we have had some challenges in the UK, and our governments are starting to look very, very silly. So across all major media outlets, The Economist, Financial Times, Bloomberg, etc., 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 you probably have seen articles about the UK and the various challenges that we've had in our operations as a country. So an energy crisis, which seems to be spreading, although I'm not sure how much of a crisis it will actually end up being, a fuel shortage, a shortage of workers in various sectors throughout the UK economy. And these media outlets, they're right in the broad strokes. But if you don't live in the UK and you were only to read what the media is telling you, you would think that there is an apocalypse happening in the UK at the moment. People are fighting each other off with sharpened, muddy sticks to get the last slice of bread in the local Sainsbury's. But it's not like that. Well, not exactly like that. And you also might be led to believe that the UK is now in a death spiral. We did the idiotic thing in Brexit, and now the country is just screwed forever. And whilst these things do sometimes contain a little flavor of truth, I don't think that things are that dramatic. So I think that the Brexit, I'm definitely in the camp that is very, very anti-Brexit and thinks it was a very stupid thing to do. And I think that it will affect our trade for years to come, maybe decades, because we need to reset those relationships. So we can't ignore that entirely because there is truth in that, but the sky is not falling. But we do need to be careful which stocks we pick. We need to make sure that companies that we're choosing are least affected by whatever those challenges might be, or maybe they're affected in the short term, but in the medium term and long term, they're fine. But just over the past week or so, I think many UK stocks, they've all been tarred with the same brush, and it doesn't really make sense. I wanted to pick out one example, and it is an example that I have used before, and that's JD Weatherspoons. And there's a reason that I picked the stock as an example, because I think it is the most dramatic, or one of the most dramatic versions of why the market is wrong at the moment. So JD Weatherspoon, they recently posted their earnings, and guess what? From July 2020 to July 2021, they had an awful financial year. This is not a surprise, particularly to anyone that's in the UK already. The UK closed down pubs for, let me check my notes, 36.5% of the year nationally. And then there was a combination of regional lockdowns and other kinds of restrictions that meant that pubs were closed or entirely or part closed for that period too. So given that the financial year runs from July to July, which is when the greatest part of the lockdowns happened, and the most dramatic parts of the lockdowns occurred, it makes sense that that reporting year would be bad. The market, anyone that's even vaguely familiar with investing should have expected that. And so revenue was down, checking notes again, 38.8% for the year. I recommend you read this financial statement. Even if you don't go through all the numbers, it's a pretty funny document. So JD Weatherspoon is not anti-government, maybe just anti the policies of the government. They think that the government has been very, very silly in what they've done, and it makes some of the statements in this document pretty damn hilarious, particularly when you start getting to the appendices. So they had a shit year. Everyone knew that. The share price dribbled down ahead of the earnings, and then the posted earnings. The earnings have continued to drop a little bit since then, and I don't know if this is just people exiting because now they have the concrete news, or because JD Weatherspoon's forecast was, we think it'll be a good year. We're confident it will be a good year as long as there aren't additional lockdowns. The government doesn't do anything too stupid. If you read between the lines, is more or less what they're saying. There is a big assumption there. If we have many, many lockdowns, the company's going to be hurt once again. But things are looking good in terms of the country's been opened up quite nicely since for the past few months, and if that continues, then I don't see any reason why JD Weatherspoons wouldn't more or less be back at the level of revenue that they were generating pre-pandemic. I brought this up here because you can see for the type of business that they have grown pretty fantastically over the decades, and their chairman, he knows how to do business. This has been a very successful business for a very, very long time. It's also a domestic business. It relies very little on international traffic. And although they need to source things like beer and food for their pubs, those supply chains aren't the very long, complicated supply chains that you might find in other places. And so this is why I think of JD Weatherspoons as one of the more extreme examples. The company is carrying some debt, by the way, and this has ticked up. As you might expect, through the lockdown. Their market cap is currently $1.7 billion. And part of what I have reiterated a few times is that, I'm trying to remember the exact number. I think that the portfolio of property that JD Weatherspoons owns is roughly 1.4 billion pounds. And that hasn't been revalued since 1999. So if there were to be an exit event, so for example, someone tries to buy JD Weatherspoons and they had to revalue those properties, or I don't know what might drive them to revalue those properties, I think the value of those properties alone might be at least double what it was when it was last valued, which is very, very interesting, besides the fact that it's a well-run business when the circumstances allow it. All right, so share price has taken a battering recently. I don't know if this makes sense because everyone should have expected the poorer earnings before. Maybe it's pricing in the risk that we have a pandemic for another year or so. Not a pandemic, a lockdown for another year or so. I'm not sure, but I don't think so. So if I could, I would add more JD Weatherspoon stock to the portfolio. Unfortunately, there doesn't seem to be enough for me to buy on eToro, because when I buy something on eToro, all of my copiers buy that too. And the amount of available stock just seems to be too small to fill those orders. Unfortunately, I can't add any more at these price levels, otherwise I would be. I did want to point out one counterpoint, and that is Rolls-Royce, which I'm trying to find in the list. So Rolls-Royce is a UK stock. They've done very well. They've done okay through the past week. They've done very well through the past month. For me, this is a turnaround play, as is JD Weatherspoon's. But Rolls-Royce has had some concrete news that has meant the stock has popped a little bit more, but I'll continue to hold that. I think it's got a bit more room to run. On to US stocks. So yeah, 1 week view. The market is open now, so this picture will be a little bit distorted by price action today. So UK stocks had a very strange week. At the beginning of the week, things looked terrible, and by the end of the week, things looked pretty good. And I'll talk a little bit about that now. So growth stocks had a decent week last week. I added a few growth stocks to the portfolio, one being Square, which I think I mentioned that last week, but also Teladoc seems to have risen quite nicely through the past week. But you can see that it wasn't just growth stocks that did well through last week. Eventually, by the end of the week, there are quite a few different industries, a mix of industries, cyclicals, defensive stocks that have done well. So last week in the US, we saw things like the fear that the US is going to default, which it's never going to happen. They kicked the can down the road until December, and they're going to have to do something between now and then to sort that issue out. But the markets sighed a sigh of relief, and that's part of the risk-on attitude that we saw last week. We also saw the jobs number for the US come in much lower than was expected, significantly lower than was expected. The market shrugged this off too. It might be that the markets think that the Fed will not taper QE or taper QE less or more slowly because the jobs number came in quite low, and maybe this was therefore an event to celebrate in terms of buying stocks, particularly those that live off of debt, rely on debt a little bit more for their growth. It's hard to say, but what we can say is that on Monday, markets were quite bearish. By Friday, things were feeling a lot more bullish. Of course, the rise in energy prices is due to what I mentioned earlier, that is a rise in the price of commodities such as natural gas and oil. By the way, I would be very careful about trading natural gas. It looks like Russia might come to our rescue, which is a little bit strange to say. And for those of you that are speculating on the price of natural gas, I invite you to look at the price of lumber. Through the first 6 or 9 months of this year, there was also an enormous run-up in the price of lumber, and there are a number of people that died on the spike after the price dropped off massively through the subsequent months. So be very careful there. So part of the reason we saw stocks bouncing around last week, and bounce they did, was also because the yield on the 10-year Treasury had a bit of a nice little bull run through the past, let's say 10 sessions. So for those of you that weren't around for the craziness in yields earlier in the year that drove tech stocks a lot lower, when yields rise, especially when they rise very quickly, it's taken as a sign that inflation, the view on inflation is that it's also going to rise quickly, which in turn is likely to make governments, the US government in this case, increase rates, which increases the cost of debt, which means that it's more difficult to grow your business or to buy things as a consumer, because the cost of servicing that debt increases at some point to a level that you can no longer afford that debt. So yields rose, and this scared more speculative stocks a little bit towards the end of the week, if I remember correctly. The US market is also going to see the real beginnings of earnings this week. The big banks will kick off. I'll talk a little bit about this towards the end of the call. China. The tone in the relationship between the US and China has shifted recently. Subtly in some ways, the type of language used by each government to describe various actions of the other government has become a little bit softer. And also we're seeing things like this, Biden speaks with Xi. The market has celebrated this, and we've seen a very good week for well, China was closed for business most of last week, but we have seen the markets operating around China do quite well through last week. By the way, China was closed until Thursday last week. So many Chinese stocks have had a very good run through, or China-related stocks have had a good run through the past week. I'm looking at the Hong Kong listed version of Alibaba here, just because that session has opened and closed completely. And you can see that through the last 5 sessions, the share price has jumped from 132 Hong Kong dollars to 167 Hong Kong dollars. It's quite a spectacular jump. So in part, this is because of the change in tone that we're seeing between the two governments. People are hoping that the relationship, which has been prickly through the past year, is improving, but also because Uncle Charlie seems to have loaded up in a big way on Alibaba stocks within this kind of price range. And what Charlie does, other people copy, and so we're seeing quite a nice jump in Alibaba. It's not the only stock that's seen a jump. There are a number of Chinese stocks that have done well through the past week. Have we seen the bottom of the Chinese bear market? I don't know. No one does really. But it does look like people are starting to come to the party, and the size of these gaps, as well as the candles, are pointing to what I mentioned last week. When people do return to this party, they're going to return in big numbers. And that's going to mean some very, very big jumps, which will drive FOMO, which I think will mean that the share price of Alibaba and many other tech Chinese businesses are going to jump massively once the party is really going. This is just something about Uncle Charlie that I've already mentioned. All right, and what I want to do finally today in terms of my update for the last week is do a rest of world update, because I do own a fair number of stocks outside of the 3 geographies that I just mentioned. So I picked up a little bit of Coupang last week. If you take a look at the chart through the IPO, which happened earlier in the year, you can see it has been a pretty dramatic dump. The IPO price was a little nuts, but this is a fantastic company that I think has been affected by sentiment around China. So I took the opportunity to add a little bit to the portfolio. It is a retail stock, and as many of you know, I am quite bullish on retail, particularly in the next quarter, but probably for a few quarters beyond that. E-commerce is taking over the world. For some reason, over the past week, and maybe it's more apparent here, retail stocks haven't done very well. E-commerce stocks, let's call them that rather. So Amazon's done okay. It's had a pretty crap month. Mercado Libre has been dropping for quite a while yet. In part, I think this is because of the rise in 10-year yields, but also I think that investors are worried that retailers, e-commerce companies are going to have a tough time sourcing and shipping things as we approach the end of the year because of the massive demand, but also because of the supply chain issues that we're having and the increased cost of shipping things that we're seeing right now. I'm happy to have these opportunities. So that Mercado Libre, for those of you that don't know, is kind of the Amazon of South America, and they are growing fast. So as you can see, this is some of the basic information. So the last quarterly earnings report, and I think I'm right in saying this, their earnings they surprised on earnings by 1,000% or nearly 1,000%. They are a company that has been growing revenue very quickly for a very long time. They're no longer just a retailer, an online retailer, like companies like Amazon are. They are also a payment provider. They're an investor in other companies, etc., etc. So you can see that their revenue has grown quickly. The forecasts for revenue growth are very, very high. They have not been making a profit for a while as they have expanded their product offering, but also geographically, and they're looking to be making a pretty strong amount of profit in the coming years. So I have been buying this company loading up on stock since I think the beginning of this year. So this recent drop is fantastic news for me. And I think it'll do us well over the next 6 to 12 months. What is happening this week? So we've seen a big move in the ASOS stock price, but I do want to make a dedicated video for that. Their earnings report, which came out today, was okay. Looking back, it was pretty good. The forecast was soft, as expected. But the big news is their CEO has stepped down with immediate effect. This worries me a little bit. I don't know that I need to get a bit more information about who the next person in charge will be, but it warrants its own video for this week. The things that are going to move the market this week are likely to be the things that have been the major players in recent weeks. Namely, people are worried about inflation. People are worried that there is going to be an energy crisis. Prices have run up very quickly, and now there's a race to see what we can do so that the average Joe can have a warm home in the Northern Hemisphere as Christmas approaches. Tapering is the talk of the day, so it's expected that tapering in the US is going to happen next month. So the market will be waiting for that, and that has massive potential to move the market when we do get more detail. Around the world, we're seeing that some countries with higher than expected inflation have either already increased their interest rates or are signaling that they're going to increase them earlier than expected. England is one example, or the UK is one example, but there are quite a few others, and that means that the cost of debt is going to rise. And as I mentioned before, that has a number of knock-on effects. And then finally, as I mentioned, it's earnings season, and we're going to kick off properly with the banks this week, and there are a few other companies too. I think this is going to be quite a rocky earnings season. I think the banks, maybe they've done okay, but anything, as I've said before, with the supply chain has almost certainly had a difficult quarter and might be forecasting a difficult quarter for the next 1 or 2 quarters. To some degree, the market is expecting this, but I think we're going to see some surprises to the downside. On the flip side, those companies that don't have massive supply chains are probably going to do okay. But overall, the market doesn't expect companies in aggregate to be increasing their margins through the next few quarters. So I think it could be quite rocky, and we're about to find out. In addition to that, of course, we're going to get some economic data. I think that the market will pay the most attention to Chinese imports and exports, because to some degree, these numbers are a proxy for global economic activity. And of course, the inflation numbers out of the US are going to be particularly interesting to the market. Now, as I usually say, as I usually caveat, these types of economic data, they can completely change month to month. They can be a horrible miss one month and then a fantastic hit the next month. So this data is often quite lumpy, which makes it just background noise that's interesting and that you might want to consider in your investment journey. But a large portion of the time, it is just noise that you can leave in the background. And finally, of course, coronavirus is still here. The good news is that even though cases might be increasing or staying quite high in a number of the larger, richer economies, the number of deaths in those economies tends to be quite low, and in some cases even trending downwards. So this is good for now. It's good for us as individual human beings. It's good for the people running businesses, and it's good for our economies. The reason is that we are probably going to have to live with coronavirus for many, many years, maybe forever. So there are lots of vaccines, and now there are drugs that are helping us live normal lives whilst the coronavirus is still everywhere. And that's good news. So if it becomes just like the common cold, where you go out every day and you're not too concerned if you get the common cold, you can conduct your business as per normal, that's great. That means that economies can begin working normally again, and that people have jobs and they're making money and there's food on the table. And hopefully, eventually, things will be hunky-dory. But I don't think we're there just yet. But it's a journey. All right, that's it for this week. I hope you have a great day, and I'll talk to you next week. Goodbye.